Welcome to Fundamentals of Accounting, Module 3, Lesson 2. Lesson 2, the first stage in the accounting process. Today, we'll be learning how to identify transactions in accounting. Identifying transactions is the very first stage in the accounting cycle, and it's essential. Every financial record, every report, and every business decision begins right here. But how do you know what needs to be recorded? Let's start with a simple definition. A transaction is a business event that involves money or a monetary value and affects at least one element of the accounting equation: assets, liabilities, equity, revenue, or expenses. Step-by-step guide: how to identify transactions. Step 1. Ask, did something happen in the business? Start by paying close attention to daily activities. Ask yourself, did we sell something? Did we receive or spend cash? Did we provide a service or maybe receive a bill? If the answer is yes, then move on to Step 2. Step 2. Check. Is the event measurable in monetary terms? This part is critical. Accounting only records events that have a peso value, dollar value, or any clear monetary amount. You should include events like selling a product or a service, paying rent, utilities, or employee salaries, purchasing equipment or inventory, receiving an invoice or a utility bill, owner investing money into the business or withdrawing funds. But you should not include hiring a new employee, unless you're paying them already, making a handshake deal with no money involved, just planning to buy something in the future. Step 3. Determine which accounts are affected. If it's measurable, now figure out which accounts are impacted. This ties the event to the basic accounting equation: assets equals liabilities plus equity. Here's a quick guide. Type of event: sale of goods, common accounts affected, sales revenue, cash or accounts receivable. Type of event: payment of rent, common accounts and rent expense, cash. Type of event: utility bill received, common accounts affected, utilities, expense, utilities payable. Type of event: owner withdrawal, common accounts affected, owner's drawings, cash. Type of event: buying equipment, common accounts affected, equipment, asset, cash or notes payable. This step helps make sure every transaction connects to the right place in your books. Step 4. Decide. Is the event a transaction that must be recorded? Ask yourself, has the event happened already? Can it be measured in monetary terms? Does it affect at least one of the main accounts? If yes to all three, then it's a transaction and must be recorded. Real-life examples. Example 1. Selling cakes to a customer for cash. Yes, it's a transaction. It's measurable. 500s. It affects cash and sales revenue, both increase. Example 2. Paying monthly rent. Yes, it's a transaction. It's measurable. 10,000. It affects cash. It goes down, and rent expense. It goes up. Example 3. Receiving a bill for internet. Yes, it's a transaction even if unpaid. It's measurable. 1,500. It affects utilities expense and utilities payable. Example 4. Deciding to hire a new employee. Not a transaction yet. No money exchanged yet. You'll record it later when salary is paid or due. Pro tip for bookkeepers: set up a daily checklist of common transactions: sales, expenses, bills, payments, owner contributions. It will help you stay organized and never miss anything important. Summary: to successfully identify a transaction, always ask: 1. Did it happen? 2. Can it be measured in money? 3. Does it affect an account like assets, liabilities, equity, revenue, or expenses? If all answers are yes, then it's a transaction, and it belongs in your accounting records. End of Module 3, Lesson 2.